KKR's co-head of credit and markets, Chris Sheldon, was out with a new note today, and in it he says that private credit is facing competition as the CLO and leverage loan markets reopen. He writes that we see private credit deals being taken out and replaced with leverage credit capital solutions and expect that trend to continue as M&A activity increases. Private and syndicated credit markets are going to coexist together as M&A picks up, and we will see demand rise across the board. And joining us now to discuss the space is Kless. He's managing partner and head of credit at Andalusian, which is backed by David Tepper. You know, Aaron, it's interesting because you actually play in a part of the market here that is not those mega deals. Right. And so what is the biggest difference that you see in private credit in the middle market versus those large cap spaces?
There is a pretty distinct difference between what goes on in the upper part of the market, where they're up there touching against the syndicated market, and what we're doing at Andalusian in the middle market. So really in the middle market, it's more of a traditional direct lending market, whereas the direct lenders who play in that upper part of the market, it's a competition against the broadly syndicated market. So we see less influence from the broadly syndicated market, particularly things like terms, rates, spreads, and trends. So we're really able to, in the middle market, see a covenanted market and a market that's really a little bit insulated from some of those syndicated market trends.
The money question, what do returns look like? Are they better at all or worse when you think about smaller companies?
Well, as a middle market lender, of course, I think the returns are better.
I have to say yes.
I have to say yes.
But how much better? Be specific.
So really, but to be specific, again, we don't have those pressures on spreads, that return compression that comes from capital flows into CLOs, the reopening of the broadly syndicated markets. So we're really able to maintain more of that spread, which is really return for our investors.
Well, the other thing that I'm wondering is how much more activity there is now versus a year ago. Because some of the business that you're operating with is what would normally go to the regional banking system. So how much has credit contracted?
Yeah, so what we do really at Andalusian, that focus on the middle market, and we're really providing leverage finance to both sponsor-backed companies and non-sponsored or independent companies. And you're right, what we've seen in the market, what we know in the market is that historically for an independent or a non-sponsored backed business, 80 to 90% of those companies get their leverage finance from commercial banks. And the story of the last 18 months has really been a huge pullback from the commercial banks. So what we've seen is an influx of opportunities for a fund like ours.
So I hear that a lot, and I'm worried as to when, the regulators come home to roost for that part of the market.
From a non-bank perspective, we're a BDC. One of our vehicles is a BDC. BDCs have been around for decades, and they're really built and designed to lend money to to middle market businesses, sponsored and non-sponsored.
So, okay, so that means that you've been around for a while, therefore what? How it works, it's okay, you can manage the risk, et cetera.
Yeah, so I think from a regulatory perspective, there's a well-designed and built regulatory regime. BDCs are regulated by the SEC, and there's a long history of data around how those types of loans and those types of vehicles have performed in the market, which I do think give the regulator some comfort.
I think also, Aaron, speaking of how loans are performing now, on one hand, it's kind of a space where a lot of money is being attracted to this industry. But at what valuations are you putting that money to work is the big question. What are the big risks that you're navigating into the next 12 to 18 months as you put new money to work?
I think, amongst the biggest risks for lenders in the middle market like Andalusian in the next, year and a half, really is, one, rates for sure, right? So higher rates for us mean better returns for our investors, but we also have to be considerate and thoughtful about our borrowers' ability to sustain higher interest expenses. So that's something we keep a very close eye on. Inflation, of course, is another one. We can see that across the types of businesses we lend to, whether it's labor rate inflation, commodity pricing, any kinds of input. So we pay very, very close attention to our borrowers' ability to sustain the leverage that we provide to them.
What are you seeing that perhaps the broader market is not seeing when it comes to inflationary pressures in particular?
Yeah, so it's a really interesting question. I think, in the middle market, and there's something like 200 or 250,000 middle market companies in the United States, every sector, every subsector and industry is reacting differently to these types of inflationary pressures. So at Andalusian, we try to focus on industries and subsectors that we think are a bit more resilient or protective against an inflationary environment. So we really focus on businesses in the sports sector, media and entertainment, and financial and specialty services. So you'll see a common theme there is, some exposure to consumers, but in ways that we think are a little bit more insulated from recessionary or inflationary pressures.
What are the common concerns that you hear right now in terms of what companies are really worried about and most anxious about?
So from a borrower perspective, a company perspective, interest rates are definitely a big one. I think more so than inflationary pressures. We've been now in this inflationary environment for a year and a half.
They're kind of getting used to it, right? So it's more like the spike in interest rates.
It is.
Do they need cuts?
And well, they certainly want cuts. They certainly do. So that's what they think about that a lot. That's impeding, for some companies at least, impeding their ability to execute on M&A or M&A strategies or other growth strategies, just given the cost of capital.
Well, you'll obviously have to be pretty selective here as you're looking at existing leverage levels, as you suggested. But are you looking at more and more companies coming to you kind of already capped out?
So that is, sometimes you do see that a company has been sort of levered up, as we say, and now needs to replace their legacy or their existing lender with a new lender. But really that market, I think, is generally pretty well addressed with other sorts of capital providers. We sort of call those solutions-based capital or rescue finance type capital, which is a pretty hot market right now, where maybe that quantum of debt that existed before that was too much is going to be refinanced out in a smaller loan, and that's something that we would look at doing and do look at doing, and maybe some equity or preferred behind it.